Okay, we'll talk about just a couple of topics before we dig back into the material. One is, at the conclusion of today's seminar, we're going to send out a couple of emails. We'll send one email with a link to the video, which will be on our YouTube channel. It'll take us a little bit, to get it uploaded, but we will definitely have the presentation uploaded to our YouTube channel. We'll send you a link to that, so that if you've missed any portion of the presentation, you can go back and rewatch it, or we're perfectly comfortable with you forwarding the link to the video to your friends in ministry. So, we sincerely are trying to pass along good information. And so if you've got a friend across town that's involved in ministry and you think they would benefit from this information, feel free to forward that to them. I have no problem doing that. Then we'll also be sending you another email about a survey, just asking you, what did we do well? What can we improve upon? We do anticipate doing something like this every year. And so we'd like to obviously improve the presentation and the information and make it as beneficial as possible. Also want to talk about or follow up on a few more questions that came in over the Facebook Live. And the first one is from Lisa: do we have to pay Social Security and Medicare? And I think the emphasis in that question is probably about the and Medicare part. So sometimes as a CPA, I get to speaking really fast, and I'll just say, yes, a minister has to pay Social Security tax on their housing allowance, and I don't throw in and Medicare. So the two of those always go together. Social Security and Medicare, there may be some situation in the world where they're not linked together, but I can't think of it. So in the U.S. tax system, for every situation I can think of right now, they are always linked together. So if you're paying Social Security, yes, you're also paying Medicare at the same time. Now, we do have a slide later on that talks about the minister's opportunity to opt out of Social Security, but unless the minister's opted out, definitely we're going to be looking at paying Social Security and Medicare. All right. Second question here that came in over the Facebook Live from Kelly: can a housing allowance be recorded on a W-2 or on a 1099? Which is the best tax form to use? So, Kelly, you've got a couple of options. If your minister is getting a W-2, and virtually almost all ministers are going to get W-2s, then the housing allowance can easily be reported on the W-2 down in box 14. That is the other box. So box 14 labeled other, you can put housing or some abbreviation for housing, and you can put the amount of the housing allowance there. Box 14 is a free box. You could write Mickey Mouse in there and they're not going to care. The IRS computer system does not do anything specifically with what you put in box 14. Now, if the minister gets audited and a human auditor were to look at the W-2 and see a number in box 14, they wouldn't pick up on it and try to interpret it. But anything you put in box 14, the IRS computer system's not automatically going to do anything with it at all. So it's like a free box, a free information box. So a second option, and I use this for many of the ministers that I prepare their W-2s because I do the accounting work for their churches, we just issue a housing letter. So we give them their W-2 that has box 1 filled in for their wages, and then we give them a separate housing letter that says, "Dear Pastor, as you know, you received $24,000 of housing allowance this year." Because the IRS simply says the housing allowance does not get reported specifically on any tax form. There's no place designed on any tax form whatsoever to report a housing allowance. I would not, and heavy emphasis on not, I would not report housing allowance on 1099. There's no place to put it. Any place you put it on a 1099 is going to turn out really bad for the minister. Because the things that go on 1099 are going to be traced back to their tax return using the IRS computer. And so that would definitely set a minister up for problems. So please do not put any housing allowance on a 1099. We've got another question here about the pastor keeps a mileage log but doesn't get paid for it. He just takes it off his income tax. Is that allowable also? Well, in the old days it was. If you go back before the Tax Cut Act that was passed in December of 2017, yes, ministers could claim deductions for their employee business expenses on Schedule A as a miscellaneous itemized deduction, but that new tax law eliminated that entirely. So employees, it doesn't matter if they're ministers, non-ministers, employees simply cannot deduct their unreimbursed employee business expenses any longer on Schedule A until and unless they revert the tax code back to the way it was before the new tax law. So it's just not an option. No, cannot deduct employee business expenses on Schedule A as a miscellaneous itemized deduction. Those are gone. So heavy emphasis on we should be reimbursing, as Kevin mentioned, we should be reimbursing all of our employees for their business expenses on a pre-tax basis under an accountable plan, meaning that they turn in their receipts, they turn in their mileage log. Okay, well, let's dig back into the materials. And so we're now on slide number 22. We're talking about health benefits. So we're still in that category of tax saving tips for ministers. And unless the minister is obtaining health insurance through another source, possibly the minister's spouse has health insurance through their employer and they're getting it on a pre-tax basis through the spouse's job, that's fine. But if not, then, the church should at least investigate trying to offer health insurance for their minister employees. And now the key phrase here in this first bullet point is the group health insurance. So employer provided group health insurance is tax-free if it is paid for by the church or offered under cafeteria plan. So first of all, a group health plan. This is not an individual health plan. So in the old days, the church could pay for an individual's health insurance policy premiums tax-free, but not anymore. Not after the Affordable Care Act, sometimes referred to as Obamacare. So after that law, any employer cannot pay for individual health insurance policy premiums for their employees. There's one small exception listed on the next slide, and I will cover that. But let's go with the assumption that we need to get a group health insurance plan if we're wanting to do something on a tax preferred basis as an employer. So we need to get a group health plan. So you can buy it from, your local health insurance agent. You can buy it online. Guidestone, I mentioned down here in the bottom bullet, is a good source. That's a large organization that does lots of benefit plans for churches. They do health insurance. They do retirement plans. If you haven't been to Guidestone yet, I'd highly recommend you check them out because they're very much on top of their game. But so if we get group health insurance and the church pays the premium, that is tax-free. And when I say tax-free, it is totally tax-free. It's not subject to income tax, Social Security, or Medicare. So that's a good deal. Employee-provided group health insurance paid for by the church is tax-free. If, though, you say, well, we want to have a group health insurance plan, but we don't want the church paying the premiums. We want to deduct the premiums from all of the employees' paychecks. Well, you can do that, but you must have a bona fide cafeteria plan to do that. You can either do a full-blown Section 125 cafeteria plan, or you can do a premium-only plan, which is still a subset of the cafeteria 125 plan. And to do that, you must have plan documents. So let me be clear here. If you're going to withhold the money from the employees' paychecks, then you've got a cafeteria plan, and you must have plan documents. There are several companies on the internet. You can just Google cafeteria plan documents for small employer. And there's lots of companies that will sell you the documents to establish your written cafeteria plan. But if the church is just going to pay the premiums out of the church's pocket and not withhold it from the employee's paycheck, then you don't need to go that cafeteria plan route. It's a little bit of a hassle to set up a cafeteria plan. But if you have enough employees and it's a benefit you want to offer, then I would recommend looking into that premium-only plan, which is a subset of Section 125 cafeteria plans. So health insurance, pre-tax, that would be a big deal. All right, so I mentioned about individual health insurance policies being a problem. So under the new law, you simply cannot be paid by the church, individual health insurance premium. So individual. The previous slide, we talked about group policies. Now we're talking about individual health insurance policies. They cannot be paid by the church unless they're paid under this QSERA, this Qualified Small Employer Health Reimbursement Arrangement. So this is a new law. I think it's 3 years old. honestly, in the 3 years, I've never seen anybody use it, but it doesn't mean there's got to be somebody using it somewhere. So let me cover the requirements for you. The QSERA plan must be established at least 90 days prior to the beginning of the year. So even if you say, yeah, this QSERA sounds like a good deal for us, let's start this, you would have to start it for 2021 because you can't start it for 2020. The deadline for that would have been October the 1st of 2019. So this would be for next year because you got to start these QSERA plans 90 days prior to the beginning of the year. They must be funded by employer contributions, which means the church is going to pay all of this money out of the church's pocket. We're not holding this money out of the employee's paycheck. The QSERA must require participants to prove minimum health insurance coverage. So if you start a QSERA and somebody says, yes, I want to be part of the QSERA, then you say, well, you've got to prove to us through documentation that you have minimum health coverage. They could have bought that through an insurance policy on the Federal Health Insurance Exchange, or they could have just bought it from their local health insurance agent. But if they don't have minimum health coverage, then they cannot be a participant in the QSERA. And then here's a big deal. It must be offered to all employees over the age of 25 who've worked more than 90 days. So if you have several staff members, you can't just say, okay, well, only the pastor will get to participate in the QSERA. All of the employees over age 25 who've worked more than 90 days. And I'll throw in full-time. You can say all full-time employees who are over the age of 25 and work more than 90 days. They all have to be able to participate in the QSERA. And remember, this is coming out of the church's pocket. And so the way the QSERA works is the church reimburses medical expenses up to these limits. If it's an individual person, a single person, the church can reimburse up to $5,250, or if it's a married person with a family, they can reimburse up to $10,600 of their medical expenses. And those medical expenses can include health insurance premiums, including individual policy health insurance premiums. So this is the one methodology that you can use to reimburse an employee's individual health insurance premiums. But remember, you got to do it for all employees. If you're in a small church and you only have one employee, well, all employees is that one employee. I don't guess that's a bad deal. But if you're in a church with 25 employees, I could see how this could become very expensive very quickly, because you also have to have the same limit for all employees. So if the church says, we're going to reimburse up to $4,000 of everybody's medical expenses, well, it is everybody, all full-time employees. So again, small church, one employee, maybe this could apply. Large church, many employees, I could see this getting super expensive very, very quickly. All right, so now we're going to talk about, well, can't the minister just deduct their health insurance premiums on their personal tax return? Well, yes, but medical expenses are only includable as an itemized deduction to the extent they exceed 10% of adjusted gross income. So, you know, if the minister's total family income between the minister and the spouse, let's say, is $100,000, and medical expenses are $11,000, including health insurance, only $1,000 would actually be included as a deduction, because the $11,000 only exceeded 10% of income by $1,000. So as you can see, it's difficult. If your medical expenses don't exceed 10% of your income, total family income, then you're not going to get to include any of that on your itemized deductions. Now, of course, other itemized deductions includes mortgage interest, property sales tax, and charitable contributions. So what you do is you take your medical expenses to the extent they exceed 10% of your AGI, and then you add your other itemized deductions, mortgage interest, taxes, and contributions, to see if you exceed the standard. The new law significantly increased the standard deduction. So for single or married filing separately, the standard deduction is $12,400, head of household $18,650, and married $24,800. If you're over age 65 and single, married filing separately, head of household, you get an extra $1,650, or if you're married filing joint, you get an extra $1,300 for each spouse that's over age 65. So let's take a married filing joint scenario here. We've got a couple married filing jointly. Their standard deduction is $24,800. If you add up their itemized deductions and they only come to $20,000, that couple is going to want to use the standard deduction because it is higher than their itemized. So all of that to say this: Can I claim my health insurance on my Schedule A as an itemized deduction and still benefit me on taxes? Yes, but not very many people will get to do it because either it's not exceeding 10% of their income, or when they add up all their deductions, it's not exceeding the standard deduction of 24.8. So that's why we put a strong emphasis on maybe we need to do the group health plan through the church so that all of those health insurance premiums could be paid for pre-tax. All right, I want to mention these alternative health plans. They've become very popular in recent years. I think after the passage of the Affordable Care Act, when there was a penalty for not having health insurance, many people started trying to figure out how they're going to get health insurance, and maybe they didn't want to get it through the exchange. So they turned to these health sharing ministries. So I'm kind of impressed by them. I'll be honest, initially I was kind of concerned. I was a little skeptical. I wasn't sure they were going to work, and would they actually pay somebody's bills? And, I was just skeptical and concerned in the beginning. But it's been several years now, and I've got numerous friends that are using them, and I've not heard one single negative comment from any of my friends and family members using them. So my skepticism is dwindling quickly. And you're probably familiar with them. There's several that are available. It's where the members of the ministry all contribute on a monthly basis, and then the ministry pays the health bills of the members. And they're structured a couple of different ways, but they all fall under the definition of health sharing ministries. Well, here's an important part for our discussion today, though, and that is that these do not meet the definition of health insurance under the tax code. Okay, so when you look at the tax code, it's super clear. A health sharing ministry is not health insurance. It's very similar to health insurance. You may feel like it's health insurance. It kind of acts like health insurance, but for tax purposes, it is not health insurance. Now, I get a lot of pushback when I say that because people say, well, I got it so that I wouldn't have to pay the penalty, the Affordable Care Act penalty for not having health insurance. And they told me it would satisfy that requirement. Yes, that is a true statement. It did satisfy the requirement. So there was a provision in the Affordable Care Act that said, if you're a member of a health sharing ministry, you're not going to be subject to the penalty for not having health insurance. It didn't say, and we now determine that health sharing ministries are health insurance. It just said, if you have them, you will not be subject to the penalty. So you've got to watch the nuances of the law there. It did exclude you from the penalty, but it still doesn't meet the definition of health insurance under the tax code. Okay. Now, that penalty that we're referring to, which was called the individual mandate for not having health insurance, it was repealed effectively on 1/1/19. So it didn't apply for 19. It's not going to apply for 20 until they, change the law again. And I use the word effectively repealed. It's just kind of funny. The penalty is actually still in the law. Here's how it was effectively repealed. The penalty was set to 0. So the penalty is still in the law. You will be charged a penalty of 0. So that's just funny things they do with Congress. Okay. Because this is the most important point for me today as in relation to our seminar. Because health sharing ministries do not meet the definition of health insurance, they are not eligible for any preferential tax treatment, and health sharing ministry payments should not be made by the church or by the employer. So I've had a couple of ministers come to me in the past and say, oh, yes, my church pays my health insurance. I said, oh, that's great. They said, oh, yeah, they make the payment to my health sharing ministry every month. I said, oh, we have a problem because they can't do that. Well, that's health insurance. No, it's not health insurance. Tax code says it's not. So a church cannot make the health sharing ministry payments for a minister and call it tax-free. It doesn't qualify as health insurance. So although I think I'm pretty impressed by these and maybe they're a good idea, for tax purposes, they're really not that great because you can't deduct the premium because it's not health insurance. Your church can't pay the premium and call it tax-free because it's not health insurance. So they may still be a great idea, not opposed to them, but just understand that we're not going to get any preferential tax treatment or tax deduction out of them. All right, I want to talk for a minute now about employee retirement plans. So I'm going to mention a couple of different types of retirement plans. First, I'll talk about simple IRAs. Now, simple IRAs are used by lots of small businesses, but they can be used by churches as well. There are some similarities between a simple IRA and a 401k, But one of the differences is simple IRAs have lower contribution limits. So if your church were to establish a simple IRA plan, more than likely through a financial advisor or through a financial company, the limit that your employees can contribute is $13,500 if the employee is under age 50, or if the employee is age 50 or older, the employee could contribute up to $16,500. And both of these are through payroll deduction. So this is where the money is being withheld, subtracted from the employee's paycheck, just like that's how a 401k works. You know, if you work for a large company and you've got a 401k, they're holding out the 401k pre-tax. The church would be holding out these simple IRA contributions pre-tax, and there's a special place to report them on the W-2 as being pre-tax. It lowers your wages in box 1. So simple IRAs can save you tax dollars. It's a fine way to save for retirement for small organizations. Here at our small CPA firm, this is what we use for our employees, is a simple IRA. Now let's talk about eligibility. You must have less than 100 employees who earn $5,000 or more. So if you're a large company or large church with more than 100 employees, you can't use simple IRA. You're going to need to look for another option. I know most of our listeners today are probably in churches with less than 100 employees. Number 2, the employee will have to meet these criteria. You must have earned at least $5,000 in any of the 2 preceding years and must be expected to earn $5,000 this year. Now, the church has the option to set that 2 years down to a 1 year. So the church could say, no, we don't want you to have to be here 2 years before you get to participate in the simple. We'll let you participate in the simple after 1 year. So the church can override this and make it lower down to 1. The church cannot increase it beyond 2, though. The church cannot say, oh, we want them to be 3 years before they can participate in the simple. No, you cannot go beyond a 2-year work requirement. But after someone has met the minimum requirements, then they get to participate in the simple IRA. And you can't, if they meet these requirements, you cannot exclude them. You can't say, oh, we're only doing the simple IRA for the pastor. We're not doing it for the youth pastor. Nope. If the youth pastor's been there the required period of time and is making $5,000 a year, you have to include all the employees in the plan. And you say, well, this money's being withheld from the employee's check, so what does the church care? I mean, you know, this is being withheld from the employee, so this is not coming out of the church's pocket. We don't have any problem. Well, here is the catch. Here is the catch on this page. As an employer, you must match up to 3% of their 3% of their wages. You must match up to 3% of their wages. So let's say you have a minister who makes $50,000 a year, whether this is the senior pastor or the youth minister or whoever. You've got a minister making $50,000 a year, and the minister says, I want to put 5% of my wages into my simple plan. Okay, that's great. You're saving money for retirement. You're going to put 5% of your $50,000. You're going to put in $2,500 of your own money into the simple. That's below these limits. So certainly the employee has made a fine decision. They're below the limits. No problem there. Now the church must match, but they don't have to match 5% because the church only has to match 3%. So 3% of the employee's wages would be $1,500, and that's how much the church would have to match. There's the $1,500. Now, if an employee says, no, I cannot afford to put in 5% of my wages, I can only afford to put in 2% of my wages, that's all I want to contribute. Well, that's fine. That's the employee's decision. Then the church would only match that 2% as well. So the church only has to match up to 3% of their wages. If the employee puts in less than 3%, then the church only matches up to the part they put in. All right. The withdrawal restrictions on a simple IRA are pretty similar to those of a traditional IRA. You're probably familiar, age 59 and a half. If you take distributions from an IRA after that, you don't pay a 10% penalty. You take distributions before that, you do pay a 10% penalty. But here's a little caveat. For simple IRAs, if you take the money out within the first 2 years of participating, it gets bumped from a 10% penalty to a 25% penalty. So what you want to advise your ministers, do not put money into a simple IRA that you're going to pull back out within the first 2 years. Because not only when you pull it out will you pay your normal taxes, you will also pay a 25% penalty. So make sure that before a minister puts money into a simple IRA, hopefully they can leave it in there till age 59 and a half, but at least they need to leave it in there for 2 years to drop from the 25% penalty down to the 10. I would prefer they leave it in there till 59.5 so that they don't pay any penalty at all. All right, let's also talk about 403B plans. Those are pretty popular for churches. A 403B plan is also very similar to a 401k, but they're specifically for nonprofits and churches. They have higher limits than the simple. So this is one advantage of a 403B as compared to the simple, is that it has a higher contribution limit. So if you have a minister that says, wow, that 13.5 that you were letting me claim or letting me contribute under the simple, I want to do more than that. Okay, well, let's go to a 403B and we can now do 19.5. Okay, so higher limits. If you're over age 50, you can put in 26,000. Now there's also an overall limit of 57,000, and here's what that's referring to. So the employee can put money out of their own paycheck up to these limits. The church can add money on top of that, but cannot exceed 57,000. So let's see, you have an employee that's over age 50, they put in 26 out of their paycheck. The church would be limited to putting in another 31 for them. Honestly, I don't see these limits hit very often, but you know, they're there, you're aware of them now. So I like 403Bs, but here is a negative about 403Bs, and that is, absent a hardship, you cannot withdraw from your 403B until you terminate employment with the sponsoring employer. So if you start a 403B at your church and your pastor is putting into it, then your pastor says, I want to get money out of that, you know, to do something, buy a boat or something, the pastor cannot take a withdrawal because they're still employed by the sponsoring employer. So they would have to quit, you know, go to a new church, change jobs or something before they can make a withdrawal. Now, there are hardship exceptions built into the plan, medical, and I think education is one of the hardships, and first-time home purchase. There's a few hardships that you can get into it. And some 403B plans allow you to make a loan out against your 403 balance, like you can get loans out against your 401k balance. So, but you know, between the loans, maybe you have some access to the money. Through a hardship, you have access to the money. But otherwise, that money is tied up as long as you're still working for that sponsoring employer. So that's a little bit of a limitation that you need to be aware of. Now, here's a really great part of 403Bs, though, and that is 403B distributions in retirement may be eligible for designation as a tax-free housing allowance. Okay, that's pretty cool. So you're a 60-year-old minister, you're gonna work for 5 more years, and you're putting, you know, $20,000 a year into your 403B. You've accumulated $100,000 there, plus it grew to 120, you know, with some interest and dividends and such. Then you retire, and you start taking it out at $10,000 a year, and you still have $10,000 a year of housing expenses. You can designate your 403B withdrawals as housing allowance, and you're not going to pay income tax on your housing allowance. And because you're retired and you're receiving this as a retirement distribution rather than as wages, you also will not pay Social Security or Medicare on that. So you're getting that money totally tax-free. So for all of my minister friends out there listening today, you know, who are getting somewhere close to retirement age, think about that 403B. The money will not be taxed going in, and then if you can pull it out as a housing allowance in retirement, it will not be taxed coming out. Now, this doesn't apply to simples, and this doesn't apply to 401ks. This is something specific to a sponsored 403B plan. And so if your church were to partner with an organization like Guidestone, then Guidestone can set all that up for you, and that can be paid out as a tax-free housing allowance. All right, next section on retirement plans here is individual retirement accounts. So you've got your old-fashioned traditional IRAs, which you deduct on your personal tax return. These are not deducted on the employee's W-2. This is not a employer issue. This is traditional IRAs are only deducted on your personal tax return in the year of contribution. You know the rules. When you take the money out later, you pay taxes on it. And your ability to deduct contributions to a traditional IRA may be limited if one spouse participates in an employer-sponsored plan and if you exceed certain income thresholds. So, you know, consult with your CPA if one of the spouses participates in another employer-sponsored plan about whether you're over the income threshold or not, and can deduct your personal traditional IRA contributions. Roth IRAs are cool. They're not deductible in the year of contribution, but as long as you meet certain criteria, you will not pay tax on the earnings. So to not pay tax on the earnings, well, yeah, you will not pay tax on the earnings as long as you've owned a Roth IRA for at least 5 years and you're over age 59 and a half. So you want to start a Roth IRA pretty early so you can start that 5-year clock ticking, so that once you reach age 59 and a half, you can start taking money out of your Roth IRA and you will not pay tax on it if you meet these two criteria. So the big difference between a Roth and a traditional, you deduct it now, you do pay tax later. Roth, you do not deduct it now, you will not pay tax later, including the growth, as long as you meet those criteria. And with a Roth, you can always get your principal back out without paying tax or penalty. So withdrawals of principal are never taxed, never penalized. Now, that's the principal. That doesn't include the interest, dividends, and capital gains. Those would only be non-taxable if you meet these criteria. Any taxable withdrawal from an IRA, Roth or traditional, under the age of 59 and a half will be subject to a 10% penalty. So when you set money aside for retirement, you need to leave it till age 59 and a half. There's your limits for traditional IRAs. So here's the second bullet point. This is important. Because traditionals and Roth are personal IRAs, we should not be paying those through the church. Those are done personally. So if your minister says, I want to contribute to a Roth or to a traditional, your best bet is just pay them the money, put it on their W-2, and then let them handle that on their personal, where they're going to put into a traditional Roth. That's their business, because traditional Roths just do not flow through an employer W-2. If a church happens to contribute to an employee's traditional IRA, you have to report that as taxable wages in box 1 of the W-2. So you haven't broken the law. If a church makes a check out to a minister's traditional IRA, you just have to add that as taxable income in box 1. Then the minister will deduct it on their personal return. That's their business. That has nothing to do with the church. Okay, so therefore there's no tax advantage for an employer to make IRA contributions for an employee. So when I say that, I'm talking Roth or traditional. I'm not talking simple. Had a whole slide on simple. Simple is great. That is an employer situation, but just regular traditional, regular Roth, those are not employer related. Those are personal. Let's talk for a minute about structuring ministerial compensation plans. So one approach is to use the residual method, which is where you first list out, add up all the tax preferred items first, and then the remainder is reported as W-2 taxable wages. So the first big category, again, is what Kevin talked about, those tax-free reimbursements. We're going to milk those for all we can do. Number 2, we'll do our fringe benefits that are totally tax-free. Then we'll do our housing allowance. And finally, then we'll be left over with our taxable wages. So let's look at a little chart here. We've got a minister that's going to make $80,000. That's the total package that the church is offering to the minister. So here's one way of structuring that. You first want to do your business expense reimbursements. Remember, these are totally tax-free. So you could say to the pastor, we're going to give you a $5,000 budget for your expense items, for your mileage, for your book reimbursements. You turn in your receipts, you turn in your mileage log. We'll reimburse all of those items completely tax-free up to $5,000. If the minister says, okay, but I turned in $5,200 worth of receipts, what are you going to do with the extra $200? The answer is nothing. Sorry, we set our budget at $5,000 and you turned in $52,000. I'm sorry about the $200. That's just the way it goes. So, ministers want to be really accurate in estimating how much they're going to have in employee expense reimbursements. And remember, as Kevin said, these have to be paid under an accountable plan. Then let's say the minister wants health insurance. The church is going to pay the group health insurance premium, $10,000. That's totally tax-free. The 403B contribution, the church decides they want to put in $12,000 into the minister's 403B plan. That's totally tax-free. That's wonderful. Then the minister says, I want to set my housing allowance at $24,000 because I've analyzed my fair rental value of my housing, and fair rental value is $24,000. So based upon Jerry's recommendation, I'm going to set my housing allowance designation at $24,000. You add all of those up, they come up to $51,000. You subtract that from the $80,000 package, and there's going to be $29,000 of taxable wages remaining, and that's what will show up on the employee's W-2 in box 1. So we started with an $80,000 package, and the minister's W-2 is only going to show $29,000. That's why we do all of this, is try to lower your taxable income and save you taxes. And it can be done. We just have to adhere to all of the nitty-gritty rules. All right. Let's see here. I think it's time for Kevin to take the mic and start talking about opting out of Social Security. Actually, I think he's answering a question, so I will start for him, and he can catch up and pick up here in the middle. Opting out of Social Security. First of all, it only applies to ministers and only to ministerial income. So your regular church employees cannot opt out of Social Security, but your ministers do have an opportunity to do so. Now, here are some of the requirements. They have to file Form 4361 by the due date of their tax return, and they have to file it by the due date of their tax return for the second year of earning more than $400 of ministerial income. Okay, so that's key. So if your minister has been ministering for 10 years and you've been paying him for 10 years and now he wants to opt out of Social Security, well, you can't do that. It has to be within the second year that he's earned $400 of ministerial income. Okay, looks like Kevin is available, so I'll turn the mic over to him.
I forgot about the delay. Seems to be about a 2-minute delay between what we're saying and where it's getting to you. Okay, so Jerry started on opting out of Social Security. I believe he's already covered the first 2 bullet points, so I'm going to hop right in. This verbiage right here is what is on the Form 4361. And I mean, I think you really should pause here and be certain that you can sign this before you even consider whether you should opt out of Social Security or not. Now, I realize you can read, but I'm going to read it to you. I certify that I am conscientiously opposed to, or because of my religious principles, I'm opposed to the acceptance for services I perform as a minister, member of a religious order not under a vow of poverty, or Christian Science practitioner, of any public insurance that makes payments in the event of death, disability, old age, or retirement, or that makes payments toward the cost of or provides services for medical care. That's out of the Social Security Act. This is not something that is to be entered into lightly. It is not something that you can do for economic reasons. It has to be a religious principle or religious conviction that is leading you to make this decision. And that statement is on the form, then you have to sign that. And another caution is that this is irrevocable. Once you opt out of Social Security, it does only apply to ministerial earnings, but you cannot go back. Once you've opted out, you cannot get back into the system. Now, Congress has in the past, I believe they've done this 2 times, they've had a safe harbor period where they've allowed ministers to get back into Social Security. It's been a long time since the second of those, and I think the consensus is that Congress is unlikely to do that again, but they might. So just remember, it has to be a religious conviction, and it is irrevocable. So why would you do this? What are some advantages of opting out of Social Security? Well, the big advantage is you will not be paying into Social Security or Medicare. So therefore, you'll be paying less tax. So what does that mean practically? If your taxable compensation, your salary is $50,000, you're going to be paying approximately, let me back up, your compensation of $50,000 includes both salary and housing. So that's the total for both of those, and you're having to pay the SE tax, which is Social Security and Medicare on both. That would be approximately $7,500 per year. So you could take that $7,500 and invest it, and you may very well end up better off economically. You would need to do pretty well for that to happen, especially given the rising cost of medical care over the last 20 or 30 years. So that's the advantage. The disadvantage, notice it's very similar. The first one is you will not be paying into Social Security or Medicare, which means you will not have any disability or retirement benefits unless you have earned 40 quarters of credits from other employment. That translates to 10 years. So if you don't have 10 years paid in through other income, you will not be eligible for Social Security benefits. Now, it is important to note that Medicare is still available to you. Parts A, Part A will cost you more than it would if you had participated in the system. B and D are about the same cost, I believe, whether you participate in the system or not. Okay, the third bullet point, last one, and this is very important, that you should be disciplined enough to save for your own retirement and purchase disability insurance coverage. I've had many friends in ministry who have chosen to opt out of Social Security, but they've not been disciplined enough to save enough for their own retirement. And probably more than half of them have not purchased adequate disability insurance coverage. Because honestly, it's very expensive to purchase that coverage, and it's tough to be disciplined and save. But it's very necessary if you're going to opt out. So please don't enter into that lightly. Briefly touch on the new 2020 Form W-4. In December of 2017, our tax code saw its most significant revision since 1986. A dramatic change. The personal exemptions have effectively been eliminated. The standard deduction was effectively doubled. Miscellaneous itemized deductions were removed. So there were significant changes. Well, in 2018 and in 2019, we did not have a new W-4 that reflected the change in the tax code. But we do now, finally. It's taken 2 years, but we do finally now have a new W-4. And the new W-4 does follow the logic and thinking of the new tax code. Well, that is very good, but it is also very challenging. Very challenging. The new W-4 form is much more difficult to complete than the old one. But before I get into that a little bit, I just want to mention again that ministerial employees can pay their own taxes by either making quarterly estimated tax payments via Form 1040-ES, just sending your taxes in quarterly on your own, or if on the new Form W-4, you complete line 4C. Now, line 4C is basically the additional tax per pay period that you want to have withheld. And that's the proper way to handle taxes for a minister if he chooses to have them withheld. The church should not be calculating the tax based on any income number. The church should be simply using the number in box 4C on the new Form W-4 or on the old form, the 2019 and previous, box 5 or line 5 was where we put additional amounts to withhold. For non-minister employees, we should have them complete a new Form W-4 because it is, like I said, more closely aligned with the new tax law. Now, the IRS has a very helpful tool. It's called their tax withholding estimator. It's an excellent tool, and it's on their website. It will walk you through, and it will walk you through single situations, married situations, head of household. You'll need to have significant information when you begin that process. You'll need to have good estimates of what your 2020 income will be. So remember, when you're doing this, you're using your estimates of 2020, and they may be very similar to what you've seen in 2019. So your income estimate, that may be easy to come up with. But the estimator will also allow you to put in income from other sources, such as interest, dividends, things like that, and help you come up with a much more accurate number. And this is the method that the IRS actually recommends you use. Go to their website and use their estimator. Now, lastly, we do have a webinar that we put together about a week ago that talks about the W-4. You might want to check that out. Here's the link. If you go to YouTube and just search for the FlockBase channel, you'll find this video as well as several videos that will hopefully be helpful to you just in using FlockBase. Okay, that is the Form W-4. All right, let's move to the Form 1099 miscellaneous. Now, the church has the burden to provide a 1099 miscellaneous form to every independent contractor that you pay more than $600 in rents, services, and other income payments. And that $600 is an annual amount. So any contractor that you pay $600 or more to in 2019, you have until the end of January to send him a 2019 1099, which shows that income. So we need to send 1099s to landlords, revival ministers, supply preachers, guest speakers, repair persons, construction workers. So the list is broad. And I would encourage you to send 1099s to everyone unless you know not to. And the easiest way to determine that is to upfront, before you pay them, before you even contract with them, is to get them to fill out a W-9. And one of the boxes on W-9, one of the sections, is where the contractor will tell you what type of entity he or she is. And you're going to find if they're C Corps, S Corps, or nonprofit, you're not going to have any requirement to send them a 1099. So if the HVAC repairman shows up and he gives you a W-9 that says he is an S Corp, then you do not have any obligation to send him a 1099. If you have him fill out a W-9 and he marks that he is a single member LLC, then you have a responsibility to send him a 1099. So it's easier to get all that information up front, and that way you know what you're going to do on the other side. And I would also recommend on the 1099s, even if you don't think you're going to pay someone $600 in a given year, it's best to go ahead and get a W-9 up front. And that way you have evidence from them of what you should do. Are you required to send them a report? And also, just in case you hit that $600 threshold, you've already got your information. So you won't be behind the curve chasing them. Okay, do not provide 1099s to employees. They get W-2s, corporations, S Corps, and also nonprofit corps. And that will include suppliers that provide only products like Walmart, Office Max, or Pizza Shop. Form 1099 miss is now due by January 31st. It's important to get it in on time, because if you do not, anytime beyond January 31st, the first 30 days, there's a $30 per form penalty. The next 30 days, there's a $60 per form penalty. And then beyond that, it goes to $100. So you should be timely on filing those 1099s. And one last note, beginning with 2020, we have a new form, 1099 NEC, which stands for non-employee compensation. That's going to be used to report independent contractor payments. So that is the info on 1099s. Let's talk about a few common reporting errors. The biggest one that we see in FlockBase is preparing 1099s for ministers rather than W-2s. Many of our clients choose to do it this way, but that's just not the way the IRS recommends. But remember, if you're only paying your pastor and all of his compensation is housing, this issue goes away completely. You can just pay him. You don't have any income reporting. There's no duty for you to report anything if he meets the qualifications for minister and all of his compensation is housing. It just gets a lot more simple. Secondly, not reporting a car allowance as taxable income. Remember, we covered this earlier. If you pay your pastor the flat amount per month, that's taxable income. If you reimburse him for actual business mileage, that's not taxable. So a car allowance is taxable. Thirdly, not reporting expense allowances paid outside of an accountable plan as taxable income. So again, if you do this through an accountable plan for reasonable and necessary business expenses, those are not taxable to the minister. Next, paying a minister's self-employment tax and not counting it as taxable income. It's okay to give him an increase to help cover half of his SE tax, but if you do that, you have to include it as taxable income. It's not okay to do that. It would be good to help offset the tax burden that your pastor has. Next, treating an employee as both a minister and a non-minister employee. What you would have here is what you would have withholding from their paycheck, but also paying them a housing allowance. And just be sure that you're treating them one or the other, either as a minister in every case or a non-minister in every case. Bottom of the slide, paying a nursery worker or staff musician as a contractor instead of an employee. Sometimes it can be difficult to decide if someone is an employee or if they're a contractor. The IRS provides guidelines and they're not real simple. It can be difficult to use them. But the general guideline I would give you is if they really are employees, if you supervise them, if you set their schedule, if you provide the materials, they're likely not contractors. But they might be. Just look, you can look at those tests if you have a edge case. Couple more here. Paying an employee's individual health insurance policy premiums outside of a Kashira. That is taxable income. Paying an employee's health sharing ministry premiums. Remember, a health sharing ministry does not meet the IRS's definition of health insurance, so that's taxable income. Funding an employee's personal IRA and then excluding it from taxable income should not be done. Failing to give a contractor a 1099. So anybody that you pay more than $600 in a single year gets a 1099 unless you know they shouldn't, and you know they shouldn't if they are a C Corp, an S Corp, or a nonprofit. Okay, I think I'm to the end of this section, so now we're going to do a little bit of Q&A. Jerry has got some questions that have come in over the internet that some of these have been answered, some have not, so I'm going to let Jerry take it from here.
All right. Thank you, Kevin. Yes, got a number of questions coming in, and we're grateful for that. I think it adds value when we get your specific questions. One thing I want to mention is Pam mentioned here that churches can file Form 8274, and that shifts the responsibility for Social Security taxes off of the church to the employees. You are correct, Pam. Thank you for mentioning that. I don't see that very often, but I know it is a possibility. Kelly, can church conferences and travel expenses be a deduction? Well, I'm going to change the terminology just a little bit there, Kelly. I'm going to say that church conference expenses and travel expenses can be reimbursed under an accountable plan, tax-free. So if we want to send our minister to a conference to learn something to become a better minister, certainly the church can pay for the airfare, pay for the hotel, pay reasonable meals while the minister is at the conference fees, all of those sorts of things. If there's a business purpose for it, that is a reimbursable business expense, but again, it's got to be under an accountable plan. Kevin's mentioned a couple of times, if the minister only gets a housing allowance and nothing else, you do not have to report that on a W-2. You could just put that in a housing letter, and a housing letter is informal and doesn't even go to the IRS. Sandra asked a good and difficult question. Thank you, Sandra. The youth director lives in the church parsonage and receives a salary for serving as the youth minister, but does not qualify as a minister because, probably the youth minister in this situation is not licensed or ordained. So you're paying that youth minister as a regular employee. That's great. But what do we do about the youth minister being allowed to live in the church provided housing? And so, yeah, great question, difficult question. There are a few situations where the providing of that housing to a regular employee could be totally tax-free. And then if you don't meet those criteria, then it's going to be value of that would be totally taxable. So this could go either way. If you meet these criteria, it could be totally tax-free. And that is that the housing is on premises of the business. So, let's say we've got the church building, we've got the parsonage right next door, and we decided to let the youth minister live on campus there. Okay, that would be criteria one. Number two, that the housing is provided for the convenience of the employer, not the employee. So the employer must have a substantial business reason for this. So, for example, let's say, oh, yes, we require that the youth minister live in this house because the youth minister has to be responsible for doing X, Y, and Z on the church grounds at all times. Maybe they're the quasi security guard, and they check all the doors and they adjust the thermostats, and if you've given them those duties that require them to live there has to be a substantial business reason. Then you've met the second criteria. And then the third one is that it must be a condition of their employment. In other words, you have to say, youth minister, here's the deal. You can live in that house, or you have to live in that house to accept this job. The youth minister says, no, I want to live in this other house across the street, across town. Nope, you don't get the job. Okay, well, then that makes it a condition of employment. But if you give them the option, say, hey, we have a house here you could live in, but you don't have any duties. It's not required. You can live here, not live here. But if you do, we haven't met these requirements for it to be a non-taxable housing situation. So that's going to be fully taxable. So in that situation, the full value of the house would be added to the W-2 and taxable income for that minister. Okay, Katie, our church is paying COBRA for our minister who is our only employee. Could we reimburse him for that without it being subject to Social Security if we had a cafeteria plan? So I'm pretty sure that the answer to your question, Katie, is that you cannot do that. A cafeteria plan could be used to pay for a group health insurance policy that your church sponsored, but obviously this COBRA plan is a health insurance policy that is being sponsored by another company, a different company. So I don't think you could use a cafeteria plan to reimburse those COBRA premiums tax-free, but I think you probably could use a QSERA plan for that. So QSERA is not requiring you to have a group health insurance plan. Remember, a QSERA lets you reimburse medical expenses, including individual health insurance premiums. So I do believe a QSERA would probably work. Now, QSERAs scare me when you have lots of employees, but I think you said your church was your only employee. So you may be the perfect candidate for setting up a QSERA, and then let the minister turn in the COBRA premiums and get reimbursed from the QSERA. So I would look for a QSERA in your situation, not a cafeteria plan. Winston, would reimbursement of supplemental Medicare premiums qualify under QSERA? I think it does. You know, that QSERA is pretty flexible on the things you can reimburse, including individual policies premiums. So I think the supplemental Medicare premiums are eligible under QSERA. Again, QSERA scare me, though, if you have a lot of employees. Our pastor is covered by his wife's teacher health insurance that is withheld from her retirement check after tax. Can we reimburse this premium and count it as a tax-free health insurance? Okay, similar question to the previous two. And so the answer is going to be pretty similar. Under a cafeteria plan, I don't think so. Under a non-cafeteria plan, I don't think so. Under a QSERA, I think so. Because the QSERA is super flexible about what you can pay for. But a uninsured plan, which is if the church was just paying the premium, that's called an uninsured plan, then that you can't do that. And then also, I'm quite confident you can't do that under a cafeteria plan. So Pam, I think your answer is QSERA only, which may or may not work for your church. I think Kevin covered in replying to the comments about the 403B plan limits were annual limits that we were listing there. Can we have both, or does it have to be one or the other? I think you can have both, although I can't think of a good reason to have both. Yeah, I mean, there's my answer. I think you can, but I can't think of a good reason to do it. I think it'd be advantageous to choose one or the other. Can you switch to a traditional to a Roth? Yes, you can get with your financial advisor, and you can convert your traditional to a Roth. You just pay tax on it when you make that conversion. Okay, I think that's all the questions I have for now. Okay, so it's about 5 minutes till the top of the hour. So if let's revisit at the top of the hour, and I hope you have a nice break, and we'll be back.